Hi everyone, and welcome to the study of financial management. The topic is Islamic finance. In our previous sessions, we studied the justification of Islamic finance, where we saw the history of Islamic finance, capitalism, halal, haram, riba, gharar, and usury. Then we discussed the principles underlying Islamic finance. We have covered the principle of not paying interest or charging interest. We've done the principle of not investing in forbidden items, ethical investing principle, the moral purchases principle. In our today's lesson, we want to study the concept of interest and how returns are made by Islamic financial securities. That will be our today's focus. How returns are made by Islamic financial securities. How returns are made by Islamic financial securities. Now, candidates, in the conventional literature, interest is seen as the time value of money. Interest is seen as the time value of money, which is sometimes described by the expression, time is money. Time is money. Time is money. However, Islamic scholars contend that time is not money. Money in Islam is seen simply as a medium of exchange. Money is seen as a medium of exchange. But in the conventional literature, time is seen as money. Okay? But from the Islamic point of view, money is just a medium of exchange with no intrinsic value in itself. So, due to that fact, candidates, it is not permissible to lend money and earn a guaranteed rate of interest on the money. And the Arabic riba means an addition to or excess over the original price. Excess. It means excess over the original price of a good or a service. And technically, this means that an increase over the principal in a loan transaction or in exchange for a commodity accrued to the owner or the lender without giving an equivalent counter value or recompensate in return to the other party. Riba is just an excess, or where the lender earns some money without a recompensate. What is in Arabic known as the iwad. Iwad, without a recompensate, a counter value. And candidates, any risk-free or guaranteed rate of return on a loan or investment is what is termed as riba, and in Islam or Islamically, this kind of arrangement is prohibited. Riba in all its forms is prohibited in Islam. But in conventional terms, riba and interest are sometimes used interchangeably, although the notion extends beyond mere interest. So, riba encompasses the various forms of what is illicit gain in Islam. Okay? Illicit what? Gain. So, candidates, in Islam, riba is one of the most abhorrent, is one of the most of all the abhorrent sins, and is absolutely prohibited. And that begs the question, candidates, if riba is prohibited, then how do Islamic financial securities make returns? How do Islamic banks, for instance, make returns? If Islamic banks cannot charge interest, the question is, then how do they make a return? Because we know conventionally that interest is one of the main sources of revenue of financial institutions. To answer that question, candidates, we need to state that there are numerous different ways that Islamic financial institutions obtain reward. In an Islamic bank, the money provided by depositors is not lent. Okay? When depositors deposit money to the bank, we do not say that the depositors have lent the bank money. No. Neither is that money lent out. The money that depositors make to Islamic banks, that money is not lent out. Rather, the money is invested on the behalf of the investors. It is done what? That money is invested on their behalf in ways that will earn profit in one way or the other. The depositor is rewarded by share of that profit. That is, of course, after a management fee is deducted by the bank. All right? So, let's move to the next part in our endeavor to answer this question, candidates. How returns are made by Islamic financial securities. Now, in Islamic financing, candidates, there are two broad categories of financing techniques. The first one is known as the Islamically permissible deferred sale contracts. Number two is the profit and loss share contract, the PLS contract. So there are two techniques: Islamically permissible deferred sales contract let me just call them techniques. I've said one is the Islamically. Remember, we are answering the question, how returns are made by Islamic financial securities. There are two categories of financing techniques. A is the Islamically permissible deferred sales contracts. Islamically permissible deferred sales contract. Under this category, we will discuss one, the murabaha. We discuss the ijara and sukuk. The second category is the profit stroke loss, PLS, profit or loss sale or share, profit or loss share contracts, profit or loss share contracts. Under this contract lies the musharaka, contracts. Under the profit and loss share contracts lies the musharaka contracts and the mudaraba contracts. Mudaraba contracts. In our today's lesson, we will tackle first the murabaha. Then in the next lesson, we'll consider the other Islamically permissible deferred sales contract. So the first one is the mudaraba contracts. Mudaraba contracts. But candidates, before we consider the mudaraba contracts, is worth noting that the Islamically permissible deferred sale contracts, the Islamic jurists or scholars have ruled it is valid. They have ruled that it is valid to sell a non-monetary asset immediately, with a deferred sale price, which possibly can be paid in installments, and that price can be greater than its cash price. Okay? That's the ruling of Islamic jurists. And the rationale behind this ruling is that the seller of an asset for a price to be paid in future, that's why it's saying deferred, a price to be paid in future, is sacrificing a benefit in order to make the asset available to the person who is buying it. The person who is buying it with a deferred payment. So, therefore, the increase in the deferred price may be viewed as compensation to the seller and not interest, as is the case in conventional dealings. The Islamic scholars have ruled that such sales are valid as long as the contract is independently specified and contained, and it contains no ignorance. All right? It's important to make that note, that Islamic jurists have ruled that it's valid to sell a non-monetary asset immediately with a deferred price, whereby the buyer is expected to pay the price higher than the cash price, but in installments. And the reason being that, the seller of that asset who is to be paid in future sacrifices a benefit now in order to make the asset available. And for that reason, the seller has to be compensated. That's why the deferred price is higher than the cash price of the asset. Now let's now study or discuss the first category of the Islamically permissible deferred sale price, that is the murabaha, Now, candidates, this form of finance refers to the sale of assets or goods at a price. And the price includes a profit margin agreed to by both the parties, the buyer and the seller. The purchase price and the selling price, other costs, and the profit margin, we said earlier that must be clearly stated at the time of the sale agreement. And the bank is compensated for the time value of its money in form of the profit margin and not interest. And this is a fixed income loan for the purchase of a real asset, such as real estate or a motor vehicle, a fridge, or whatever asset. And it has a fixed rate of profit determined by the profit margin. Candidates, the bank is not compensated for the time value of money outside the contracted terms. That means that the bank cannot charge additional profit on late payments. It cannot charge, as is the conventional way of doing business. The bank cannot charge for default in payments. It should be noted that, however, the asset remains as a mortgage with the bank until the default is settled. A good case is the murabaha mortgage. Good example of a murabaha contract is murabaha mortgage. Murabaha mortgage. For us to understand this concept, let's give an example of a murabaha mortgage. It might be clearer to understand. It might be clear to understand this concept if we give an example of a murabaha mortgage. Now, how does a murabaha mortgage work? How does a murabaha mortgage work? How does a murabaha mortgage work? Now, candidates, a murabaha mortgage works this way. Number one, an individual or a family finds a house to purchase and agrees a sale price with the seller. So there are two parties here. Number one, you're answering the question how murabaha mortgage works. Number one, I've said an individual or a family, number one, identifies a house from a seller. We have the buyer and seller of a house. There are two parties. The buyer can be an individual, the buyer can be a family who finds a house, identifies a house from a seller, and agrees on on a price. Okay? Now, candidates, as is the case with any mortgage, the individual arranges a mortgage with his or her bank. In this case, is the Islamic bank. Another party we have here, the individual buyer arranges for payment with an Islamic bank. That is the case with any mortgage. They have to identify the financier. Okay, in this case is the Islamic bank. And typically, the individual will have to provide a deposit of the purchase. Buyer makes a deposit, and this deposit can be say 25% of the purchase price of the house. At the time, the individual will have to do what? To provide about, say, 25% deposit of the purchase at the time when he or she identifies the seller of the house. Then number 4, the bank will then buy the asset, which is the house, and then sells it immediately to the buyer at a higher price. At a higher price. At a higher price. And it should be noted that in this case, the bank will make a profit on the transaction and will not charge interest. The bank will do what? The bank will make a profit because the bank has bought a real asset and sold a real asset to this buyer. There is no interest that is charged by the bank. Then, number 5, candidates. When purchased, the property is registered in the name of the borrower. All right? This property, this house is registered, for instance, a house is registered in the name of the borrower, and the sale between the borrower and the bank is recorded in the Murabaha contract. Those are two things. Number 1, the property is registered in the name of the borrower. Property is registered in the name of the borrower. This the borrower is the buyer, the one who wants to buy a house but has no money. So the bank comes in and pays for him the house or her the house. That house is registered in his or her name of the borrower. Okay. Property is registered in the name of the borrower. I said there are two things. Then number 2, the sale between the borrower and the bank is done what? Is registered in the Murabaha contract, or recorded, is recorded in the Murabaha contract. Let me put it as number 6. I've said that the sale between the borrower and the bank, sale between the borrower and the bank is recorded in the Murabaha contract, number 6. Then number 7, candidates, the individual will then pay back the lender the resale price in fixed installments. Buyer pays back the lender in fixed installments. Buyer pays back the lender in fixed installments until the property is fully repaid. Until the property is fully repaid. Until the property is fully repaid, or let me say fully owned. That is number 7. All right. Now, candidates, at this point we need to note that the repayment remains the same, and this way is the point of departure. Point of departure between Islamic financing and conventional financing. That the repayment remains the same regardless to what happens to the level of interest rates. And this is because the borrower or the individual is paying the bank its profit and not interest. And in philosophical terms, candidates, it is the house that is earning the profit and not the money that is used to buy the house, which would be the case when interest is paid on borrowed amount. Candidates, the difference between the original purchase price, all right, the original purchase price, the difference between the original purchase price. Remember, in point number 1, the buyer and seller agreed on a price. This is the original price. The difference between this original price and the higher price. Remember here, we say that the bank will buy the house and sell it at a higher price. The difference between these two prices, all right, at which the property is resold to the individual. Individual is sold the property at a higher price by the bank, all right, provides this difference, provides the Islamic lender with a profit. The Islamic lender is the bank. The bank earns a profit that is compliant with Islamic law. And we also need to note that if the borrower is late on their payments, the bank cannot charge any late penalties. Cannot do what? Cannot charge any late penalties. Now, candidates, at this point, we need to ask ourselves a very important question. And the question is the profit margin the same as riba or interest? Because we noted in number 4 here that the bank charges or buys the house at a higher price. The difference between this higher price and the original price is the profit. So is this profit the same as interest? And candidates, it may appear at a glance that this profit or the markup is just another term of interest that is charged by conventional banks. And candidates' interest, it could be argued, and it has been argued by critics of Islamic finance that interest under this arrangement is being admitted through the back door. Yet, candidates, the legality of the traditional type of murabaha is not questioned. And it is not questioned by any schools of Sharia law. So, from the perspective of the Sharia law, this profit is not regarded as riba. Though it may appear from those who criticize Islamic finance that this profit is a way of introducing interest through the back door. That's an important question. And having said that, we'll now move to highlight reasons why murabaha mortgage is Islamically acceptable or permissible. All right? That's the question we want to ask ourselves and answer. Is the murabaha contract Islamically compliant? Now, candidates, what makes the traditional murabaha transaction Islamically legitimate is that the bank first acquires the asset. The bank first acquires the asset for sale at a profit. We read here that the bank will buy the asset and sell to the buyer, so that a commodity is sold for money. And the operation is not a mere exchange of money for money, as is the case for conventional banks. In other words, the bank is the seller and not the provider of funds. The bank is a seller, is selling. The bank is selling to this buyer. The bank is not providing funds to the buyer. It's selling a tangible asset. And in the process, the bank assumes certain risks between purchase and sale. For example, the risk could be a sudden fall in price that could see the company refusing to accept the goods at the agreed higher price. And that is that the bank takes ownership responsibility for the goods before it is safely delivered to the company. So the services rendered by the Islamic bank are therefore regarded as quite different from those of conventional banks, which simply lends money to the company or to the buyer so that it can then buy the goods itself. This buyer could be company or an individual. So then that proves from the Islamic point of view that the murabaha contract is Islamically compliant. Is Islamically compliant. Candidates, I hope I've been clear in explaining how Murabba mortgage works. Remember, I sought in the beginning to explain how returns are made by Islamic financial securities. This is one way, because we noted that there are two categories of techniques which Islamic institutions use to make returns. One being the A, Islamically permissible deferred sales contracts, then B, profit and loss share contracts. In our today's session, I've explained how returns are made by the Murabaha contracts. Murabaha contracts. In our next session, I will focus on Ijara contracts. Then we'll also look at the other techniques in our subsequent sessions. Thank you for attending this Islamic finance study session. In our next class, we continue looking at this interesting topic. Thank you. God bless you. Bye.